Welcome to a new IFRS Educational Fund Service. It is an initiative of OJ Inspiration Limited. It is dedicated to providing complementary and supplementary education on International Financial Reporting Standards IFRS through a multiple choice question and answer approach. It is intended to make learning an intellectual assurance fun. In this session, we shall be considering cumulative set 210 questions to which the answers will be provided on IAS 8. This is standard accounting policies, changes in accounting estimates and errors. Viewers and subscribers have 30 seconds to select or choose their answer to each question. The answers to the cumulative 10 questions are reviewed at the end of all the questions. Please enjoy it. Question number 11. The specific principles, bases, conventions, rules, and practices applied by an entity in preparing and presenting financial statements are called A. Accounting policies, B. Accounting concepts, C. Accounting framework, D. Reporting framework, E. IFRSs. Time counts. Ten seconds gone. Twenty seconds gone. Time up. Question number 12. Seek interpretations go with IASs as what goes with IFRSs. A. Seek interpretations also. B. IAS interpretations. C. IFRS interpretations. D. IFRS interpretations. E. IASB interpretations. Time counts. Ten seconds gone. Twenty seconds gone. Time up. Question number 13. It is not one of the disclosures required on the initial application of an IFRS. A. The reasons for applying accounting policy provides reliable and more relevant information. B. The nature of the change in accounting policy. C. The amount of the adjustment relating to a period before those presented. D. The amount of the adjustment to each financial statement line item affected. E. The amount of the adjustment for basic and diluted earnings per share. Some counts. 10 seconds gone. Twenty seconds gone. Time up. Question number 14. Disclosure on one of the following is not required. A. Current period error correction. B. Past period error correction. C. Voluntary change in accounting policy. D. Initial application of an IFRS. E. New IFRS issued but not yet effective. Time counts. Ten seconds gone. Twenty seconds gone. Time up. Question number 15. Adjusting the comparative amounts in the financial statements does not arise in A. Voluntary change in accounting policy. B. Mandatory change in accounting policy. C. Correction of prior period errors. D. Change in accounting estimates. E. None of the above. Time counts. Ten seconds gone. Twenty seconds gone. Time up. Question number 16. A motor vehicle which cost 30 million naira with a 4-year lifespan was reassessed to have a 6-year lifespan after its 3 years of use. If the retained earnings closing balance at year 3 end was 800 million naira, what would be the balance of retained earnings at year 4 end? A, 795 million naira. B, 802,500,000 naira. C, 707,500,000 naira. D, 792,500,000 naira. E, 780 million naira. Time count. 10 seconds done. 20 seconds done. Time up. Question number 17. The income tax expense line items in the draft financial statements of an entity were 4 million naira and 2 million naira for the years ended December 31, 2023 and December 31, 2022, respectively. A tax audit in 2023 revealed an underestimation of 1 million naira in year 2022 profit. How much will be finally presented for this line item in the comparative year December 31, 2022? A, 2 million naira. B, 3 million naira. C, 1 million naira. D, 6 million naira. E, 5 million naira. Time counts. 10 seconds done. 20 seconds done. Time up. Question number 18. The income tax expense for the year ended December 31, 2021 was recognized as 4 million naira, only for an omission of 2 million naira related to it to become discovered within year end December 31, 2022, with its own income tax expense being 8 million naira, without the correction of the omission. By how much will the finalized income tax expense line item for December 31, 2022 be increased? A, 2 million naira. B, 4 million naira. C, 6 million naira. D, 8 million naira. E, nil. Time counts. 10 seconds gone. 20 seconds gone. 'Time up. Question number 19. Retained earnings opening balance for a comparative year ended December 31, 2023 was 12 million naira, before an error of omission of revenue of 22 million naira, cost of sales of 50 million naira, with associated income tax expense of 3 million naira was discovered about previous years. What will be the opening balance of retained earnings restated for January 1, 2023? A, 12 million naira. B, 19 million naira. C, 31 million naira. D, 16 million naira. E, 9 million naira. Time counts. 10 seconds done. 20 seconds gone. 'Time up. Question number 20. An ascertained net increase in retained earnings by 6 billion naira for prior periods due to change in an accounting policy was impractical to be identified with specific periods or for prior periods. With retained earnings opening balance of 18 million naira and 13 million naira for the current year ended July 1, 2020, and the comparative year ended July 1, 2019, respectively, which of the following holds? A, open balance of retained earnings for July 1, 2019 becomes 19 million naira. B, opening balance of retained earnings for July 1, 2020 becomes 24 million naira. C, opening balance of retained earnings for July 1, 2019 becomes 60 million naira. D, opening balance of retained earnings for July 1, 2020 becomes 21 million naira. E, opening balance of retained earnings for July 1, 2020 becomes 18 million naira. Time counts. 10 seconds done. 20 seconds gone. Time up. We proceed to review the answers. Question number 11. The answer to question number 11 is A, accounting policies. IAS defines accounting policies as the specific principles, bases, conventions, rules, and practices applied by an entity in preparing and presenting financial statements. A is the answer to question number 11. Question number 12. The answer to question number 12 is C, IFRS interpretations. IFRS interpretations are sets of timely guidance provided on newly identified financial reporting issues not specifically addressed in IFRS, or on issues where unsatisfactory or conflicting interpretations have developed or seem likely to develop. The interpretations released before March 2022 on IAS were called SIC, that is Standing Interpretations Committee interpretations. The ones issued afterwards are called IFRS interpretations, and they were released with respect to IFRS. C is the answer to question number 12. Question number 13. The answer to question number 13 is A, the reasons why applying accounting policy provides reliable and more relevant information. All of the options except that of option A are disclosures required on the initial application of an IFRS. Option A, which is on disclosure of the reasons why applying an accounting policy provides reliable and more relevant information, is required only where there is a voluntary change in accounting policy. This disclosure is not required on the initial application of an IFRS. A is the answer to question number 13. Question number 14. The answer to question number 14 is A, current period error correction. Disclosure is not required on or about current period error correction. Current period errors discovered are corrected before financial statements are authorized for issue. A is the answer to question number 14. Question number 15. The answer to question number 15 is D, change in accounting estimates. Change in accounting estimates leads to prospective application. Prospective application in this case is recognizing the effect of the change in the accounting estimates in the current and future periods affected by the change. It does not include prior periods that necessitate the adjustment of comparative amounts. D is the answer to question number 15. Question number 16. The answer to question number 16 is C, 797,500,000 naira, or 797.5 million naira. Revision of depreciation charge is a change of accounting estimate, and this is prospectively applied. This means that the effect of the change is reflected in the current period and into the future periods where applicable. At the end of year 3, the carrying amount of the motor vehicle was 7,500,000 naira. Since the useful life has increased to 6 years, there are 3 more years of use, including the 4th year. The carrying amount of 7,500,000 naira at the end of year 3 is divided by the 3 years remaining, which gives 2,500,000 naira depreciation charge per year from year 4 into year 6. The year 3 retained earnings closing balance of 800 million naira less 2,500,000 naira gives 797 million naira 500,000 naira, which would be the closing balance at the end of year 4. C is the answer to question number 16. Question number 17. The answer to question number 17 is A, 2 million naira. The underestimation revealed through the tax audit is a change in accounting estimate, as the amount of income tax determined by an entity is an estimate. Since there is a change in accounting estimate, which is prospectively applied, the 1 million naira additional income tax liability is reflected in the current year end of December 31, 2023 on the income tax expense line item. The amount for year end December 31, 2022 is left untouched, even though the underestimation relates to the year. This is the effect of prospective application. A is the answer to question number 17. Question number 18. The answer to question number 18 is E, nil. The event is a case of prior period error, which is corrected within the line item amounts or balances of the relevant prior year. A retrospective restatement is done. Therefore, the income tax expense line item for December 31, 2021 will be increased by 2 million naira to become 6 million naira. The income tax expense line item for December 31, 2022 remains unchanged. E is the answer to question number 18. Question number 19. The answer to question number 19 is D, 16 million naira. The incremental profit is 22 million naira revenue, less 15 million naira cost of sales, and less associated income tax expense of 3 million naira. This gives 4 million naira. The 4 million naira related to the previous year is added to the opening balance of the comparative year to get the opening balance restated for retained earnings of 16 million naira as of January 1, 2023. D is the answer to question number 19. Question number 20. The answer to question number 20 is B. Opening balance of retained earnings for July 1, 2020 becomes 24 million naira. Where it is impracticable to determine the period-specific effects of change in an accounting policy on comparative information for one or more prior periods presented, an entity applies the new accounting policy to the current amount of assets and liabilities at the beginning of the earliest period for which retrospective application is practicable, which may be the current period, and makes corresponding adjustment to the opening balance of each affected component of equity for that period. As the impracticability applies to all prior periods in this question, adjustment is made on the opening balance of retained earnings for the current period of July 1, 2020. The 6 million naira net effect increases the opening balance of retained earnings from 18 million naira to 24 million naira. B is the answer to question number 20. That is all for this set 2. Thank you for joining us for the set 2 of IAS 8, Accounting Policies, Changes in Accounting Estimates and Errors. We invite you to subscribe to our channel, share our links, and invite those in your network to do the same. This will enable you and all other subscribers get direct notifications on future video uploads. We intend to cover all of the standards in this framework and create further sets of questions and answers on standards already covered. For collaboration in this area, please call or WhatsApp +2349 030 770109. All rights to this production and others in this service are reserved for OJ Inspiration Limited. Thank you once again, and bye for now.